business buying or selling from the investee. Because we can't make money off of ourselves. We can't make money from ourselves. So let's assume, and this is not part of chapter 1, but if the parent controlled the other corporation, the subsidiary, was 100% owned subsidiary. If the parent sold to the subsidiary, then any gross profit that they receive is making it off of themselves. That's an impossibility. GAAP doesn't allow that, right? So what happens is, when the parent sells to the subsidiary, or the subsidiary to the parent, because the parent controls the subsidiary, any gross profit that was made intercompany between the two companies, intercompany, has to be deferred until that inventory is sold outside of the group. Okay? So far so good. Does that make sense? So what we have to say is, and let's review a couple of things. First of all, let's review entries for sales and purchases. This is Principles of Accounting 1. Okay? So the seller does this. They do debit accounts receivable, credit sales, right? And then debit cash, credit accounts receivable. They also do this. Debit cost of goods sold and credit inventory. You remember this. The buyer does this. Debit inventory, credit accounts payable, debit accounts payable, credit cash. So far so good. All right, well what if this was $500 and this was $700? So far, so good. Something we had bought for $500, we sold for $700. They would only be recording the $700. Okay? So now, when we mush the two together, or when we show these two together in the intercompany group, there's a $200 gross profit. Sales minus cost of goods sold is $200. So when we get into consolidations, and actually this is chapter 5, but in chapter 5 we do this again, and we're not doing chapter 5 in this course, okay? But when we do that, we're going to have to remove the sale, remove the cost of goods sold, restate the inventory back to $500. But for now, what we need to know is there's $200 of gross profit, some of which, since we don't own all of it, in this chapter, we own maybe 40%. Well, it's as though 40% is still owned by the seller. So that $200 times 40%, or $80, needs to be deferred. The other 60% has been sold since it's owned, since the 60% is another owner, then it was actually sold outside. So it's fine. So the objective here in this section is to get the portion that the parent or the investor owns and defer it. Okay? The other thing as a review, I think you've got those. The last time, and can you see okay? I'm just double checking to make sure that okay. We said the 4 T accounts. So for the equity method, we have investment and investment income. This is the equity method. Then we have the cost or fair value method. And we have either AFS or trading, right? And then we have dividend income. So asset, revenue, asset, revenue. We also know that the purchase price goes here It goes up for our share of net income, down for amortization, we did that, down for our share of dividend, right? And this is our share of net income and amortization. Over here, it's the purchase price, and we revalue the portfolio using a fair value allowance account. And then this is our share of dividends. So far, so good. And we're going to memorize that. All right. Well, just like this was debit to investment, credit to investment income, and this is the opposite, credit to investment, debit to investment income. So the deferral of gain is the same as the amortization. So the deferred gain is that journal entry. It looks like the amortization journal entry. I did remember to bring my books. So would you go with me, please, to page 18. Notice at the bottom of page 19, first of all, we'll talk about how they computed the deferral. How much? What is the amount? Okay, I'll give you a formula for that. But they computed it to be $1,200. That's coming as our next concept. But right now, you see that what they did was they debited income. They call it equity in investee income. The key there is income. It's a revenue account. Whether it's called investment income, investees income, equity in investee, I don't care what they call it, it's income. Okay? It's the revenue account, whatever name they give it. And they credit the investment in the investee. Okay? So they are debiting the revenue and crediting the asset, both of them going down. Are we okay with that? Is that pretty clear? Okay. So how do we do it? It's a times, 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 times. Okay? And I'm going to give you a formula. Sometimes they will have already given you pieces of it already multiplied. Okay. It's intercompany sales. In other words, the sales price, the one that we just did was $700. Times. Like I want. Okay. Times sales in ending inventory. Well, you know what? I'm going to do something else first. Times, I want the gross profit. So, intercompany sales minus cost of goods sold divided by intercompany sales. So what is this intercompany sales is going to go all the way through, okay? Lots of times. The amount of the sales, in our case, that was $700. The intercompany sales, $700, minus the cost of goods sold, in our case, that was $500. Are you with me so far? So that is the gross profit, is the numerator. Divided by the intercompany sales, which gives us a gross profit percentage, or the gross profit ratio. Okay. Sometimes they give you that. So you don't have to do this. Times, and this is going to be how much is remaining, because if it's already been sold outside, then we don't have to defer the gain. Okay? So company A sells to company B, and company A is a major investor in company B. But if most of it's been sold to company C, then we don't defer the gain. But as long as it's staying in company B, we have a deferral. So, intercompany sales in ending In other words, the percent in ending inventory. Or you could also do it as ending inventory divided by intercompany sales. Okay? In fact, I think I'll do that. So I'm just using so ending inventory divided by intercompany sales times the percent of ownership equals deferral of gain, deferred gain. So it's a times, 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 with some division in there, and and a little bit of subtraction, right? So in the one that's on page 19, third of the way down, it says, assume that major company owns a 40% share of minor company and accounts for this investment through the equity method. Well, here's the 40%, right? 40%. They sell inventory at a price of 50. Right? So I can put 50 here, I can put 50 here, I can put 50 here, and my 3 multiplication signs. So far, so good. And it says minor has includes a gross profit of 30%, or 15,000. Well, they already gave me that, so I could either do 15 over 50, or I could just do 0.3. They already told me that. Or I could compute 70% is 35,000, and I could do 15 minus 35 is 15. There's going to be different ways to do this, but what I want is the gross profit percent. Okay? But they gave me the 0.3, so I'm going to use it. That's the easiest way, right? So it is intercompany sales. That is called gross profit percent. That's the percent in ending inventory, right? That is this, that is that. So sometimes they give you the gross profit percent. They did this way, this time. So far, so good. All right. Then it says, minor has sold 40,000 of these goods to outside parties. So there's only 10,000 in ending inventory. And now I do my math. So 50 times 0.3 times 10 over 50 times 0.4. And since they're all multiplication and division at this point, I can just do it straight in a string on my calculator. If I had to do this, I'd have to do mine minus first. Do your addition subtraction first. Don't make me be a math teacher. I'm not one. Okay? And that's how they got their $1,200 on that page. And what they're going to do is defer the gain for this year. Next year, we'll flip that. So this would be, that was, by the way, in 2015. So in 2016, we do this. Undefer it, or recognize it. We take that $1,200 and we make the opposite entry in 2016. Now we may also have a new deferral. So this would be last year, and this would be this year, current year. Make sense? Questions? So all we're doing is we're saying the investment income shouldn't be as much because some of our investment income is the gross profit we made on ourselves, indirectly. All right. So, problems 10, 11, and 12, 19, 25, and 26, and 27. We won't do them all. But we will do 10, 11, and 12 because they're multiple choice. Number 10. Perez applies the equity method for its 25% investment in senior. During the year 2015, they sold goods with a 40% gross profit, so they've already computed one of the things for you. They sold all these goods in 2015. So Perez sold to senior or senior sold to Perez, it doesn't matter. By the way, if big sells to little, that's downstream. If little sells to big, that's upstream. Okay? So if the investor sells to the investee, that's downstream. The investee sells to the investor, that's upstream. In this chapter, it does not matter. In chapter 5, it does. But Perez is selling to Senior. So this is a downstream. Doesn't matter for this computation and for this chapter. But Senior has already sold it to somebody else. So the answer is there's no adjustment necessary because this ending inventory is 0. And 0 times anything is 0. So the answer is D dog. There's no adjustment necessary. Is that clear? Because it's been sold outside the group. As long as it stays in the group, we must defer it, and the next year we undefer or recognize it. Isn't that cool? Just a little bit of a puzzle. You say, well, what if it's still there? Well, then when we do this entry for the next year, it'll be part of it. It'll still be there. So we'll undo it, and then we'll redo it if it's still there. But that's not likely. Inventory typically comes and goes pretty quickly. Questions? So 10 is D-Dog. Number 11, Panner owns 30% of Watkins, applies the equity method. During the current year, they buy inventory costing $54,000, sell it to Watkins for $90,000. Is this an upstream or downstream? Who is the investor? Panner. And who's selling? So this is upstream. This is upstream. Watkins is little. Now, not necessarily. I mean, you know, but I think of the investor as being big enough to buy them. So I always think of the investor as big and investee as little. It's not necessarily so, but in my mind, that's how I keep it straight. Okay, so they buy inventory costing $54,000, sell it to Watkins for $90,000. At the end of the year, Watkins still holds $20,000 of the merchandise. What amount of gross profit? So we're going to do our times. Ready? What do I know? I'll take one piece at a time. 30% is 0.3. 54. Yeah, 54 goes in there. But 90 goes here, and here, and here, and here. The price that both of them know is the one that goes everywhere. Watkins still holds only 20,000. Sometimes they say they've sold 70. 90 minus 20 is 70. Or 90 minus 70 is 20, sorry. Right? And then we do that, get a gross profit percentage, 2 ninths, 90.3, and the answer is? Questions about that? So we went from no complexity, number 10, there was nothing held at the end of the year, to using 1 year, number 11. Now let's look at 2 years, number 12. Alex buys 40% of Steinbar on January 1st, 2014 for $530. The equity method of accounting is to be used, which means they have the ability to exercise significant influence. Remember that concept. The net assets on that date were $1.2 million. Any excess of cost over book value is attributable to a trade name with a 20-year remaining life. Immediately they began supplying inventory. So they bought them, Alex bought Steinbart. So Alex is big, Steinbart is little. Steinbart began supplying, so this is upstream or downstream? Upstream, little is selling to big. That's why they bought a huge portion, is so that They could buy from them, control delivery, control pricing, control quality, whatever, okay? Or maybe all three. And then it says in 2014, they give us a cost, that cost of goods sold number, then they give us the transfer price, the sales price, and the amount held at the year end. Inventory held at the end of year one is sold at the beginning of the next year, so we would undefer 2014 in 2015. Steinbart reports 80,000 in 2014, 110,000 in 2015, 30,000 dividends in each year. What is equity income in Steinbart to be reported by Alex in 2015? So the first thing we have to do is this twice. We have to do the 2014 and the 2015. So let's do that. We do times, times, times. So we've got the big number is 100. The little number is 70. 100 minus 70 over 100. Okay. Year end 25 over 100. And the ownership percent in this problem is 0.4. So I'll let you work on that. And you see that the 2014 gross profit is, I believe that's $3,000. Am I right? Does that come up to $3,000? So 3,000 is the 2014 gain to be deferred. I'm going to take this problem a lot further than what they want me to, okay? Because I can ask you all kinds of things. What is the deferred gain for 2014? What is the deferred gain for 2015? What is the investment income in 2014? What is the investment income in 2015? Which would be a combination of three things. Four things for 2015, because you got to undefer and defer. What is the balance in the investment account at the end of 14? What is the balance in the investment account at the end of 15? All those are good questions from this one problem. Okay? So what we're gonna do is we're gonna use our T accounts, and then we can pick the answer where we need to. Does that make sense to you? Okay. So, 3,000 for the first year. Did you do the second year? I'll do it quietly. You get 6480. Okay. All right. Now we're ready to answer their questions. So, in the first year, well, first of all, we know it's equity methods. Step number one, equity or fair value equity. Step number two, we do a DDES. So our DDES, Derek, can you still see me?
Yep.
Okay, good. The DDES, we start with the purchase price, $530. The book value times our percent, right? This is reviewed last time, so it says net assets on that day. Remember, book value, net assets, assets minus liability. What was the other one? Book value, net assets, assets minus liabilities, stockholders' equity. Yeah, those four things are all fair game here. 1.2 million, but we didn't buy all of it. We bought 40% of it. we determine our excess to be 50. So far, so good. Okay. And it says it's all attributed to a trademark. So there's no goodwill. And there was a 20-year life. Is $2,500 of amortization each and every year for 20 years. Can you do that? Yeah, just go out to the sign and do your amortization. Sophia, you lost?
No.
Got it?
Yes.
What we're doing is we're saying that we paid $530,000 for something that has a book value of $480,000. There's two reasons, remember, that we would pay more. Number one, we've got under or overvalued assets or liabilities. And we have one not recorded. Maybe we created this trademark and therefore it's not on the books. It was done in R&D, and so we expensed it as incurred, but it has a value. Okay? And so it's undervalued by $50,000, which explains all of the reason that we paid the extra $50,000, and therefore there is no unidentified reason, therefore there is no goodwill. Okay. But that trademark has a life, and the life is 20 years, and it will not last forever, and so $2,500 a year is its amortization. So we're ready to do this. The purchase price, $530,000. Our amortization for a year, 2.5, 2.5. Right? Is a debit to investment income and a credit to investment. Our share of net income for the first year, it says in the first year they had $80,000, but we didn't earn all of that. We earned 40% of that. So that would be 32 and 32. 80,000 times 40%. The dividends in 2014. It was $30,000 each year. Our share, 40%. 3 times 4, 12. But remember that the other side of that one is cash, debit cash. So it's not up here. Dividends are not part of this. It is for the fair value method, but not for the equity method. Okay. The deferred gain for this first year was $3,000 and $3,000. Debit investment income, negative. Credit investment, the asset, negative. And so that would give us, I don't know, 562, 550, 542, 500 or something like that would be our balance here, I think. I don't have it. I don't have a subtotal. What do you have when you, this plus this minus those three things?
544.25.
Okay, so that's what we have. If I asked you what is the investment balance at the end of 2014, it'd be 544.5. And if I asked you for investment income, it would be this would be 26.5, right? That's at the end of year 1. But they're asking you for the amount of income for year 2. So that gets closed, 26.5, and goes back to 0. The first thing we do in the next year, we have this continuing balance for the asset and a 0 for the income. Yes? Okay. First thing we do next year is we reverse the 3. We also want to record the 6.48. So we're undeferring last year's, deferring this year's. And then let's do our normal things. We've got amortization. but you're only going here, don't go both. The other side is cash, debit cash, credit investment. And then our share of income, and it's 110,000 of income times 40% is 44 and 44. So what they want, what they're asking you for is the net of that number, 38,020. But I could also ask you for that number, whatever that is.
What's the 44?
110 times, that's net income. Up for net income, remember the pieces. Up for net income, down for dividends, down for amortization, down for deferred gain. But also up for undeferring the gain. So, last year, deferred gain. So, and really, honestly, folks, that's all you're going to have to, those 6 pieces to the puzzle are what you're going to have to know. So, at first it seemed real simple because it was just 3. Purchase price, net income, dividends, right? And then I threw in the amortization. Right? Now I've thrown in 2 more things, this year's deferred gain and last year's deferred gain. That's it. We're done. So those 6 pieces. And doesn't that make sense? That the deferred gain of this year is making investment income go down. Right? But last year's deferred gain is making investment income go back up. Is that clear? Because we're deferring or we're postponing or we're minusing out income. Boy, there's so many great ones here. 19 is good because it's got a couple of concepts in it. 25 is good. Oh, I'm sorry. Thank you for asking. 38,020, which is B-boy. This is 38,020. I think we'll do 19 and 25, and then I would strongly encourage you to do 26. No, we'll do 19 and 26. I strongly encourage you to do 25 and 27 on your own. So number 19. Time Rent Incorporated, page 31, sold $150,000 in inventory to Schilling during 2014 for $225. Schilling resold $105,000 with the remainder to be disposed of during 2015. Assume they own 25% of Schilling, apply the equity method. What journal entry is recorded at the end of 2014 to defer the unrealized gross profit? So all we're going to do is a times, and then do the journal entry. So let's plug in the numbers. What is the transfer price, which is the big number? Okay, 225 can be put all kinds of places. All right. And the little number, what was the cost to the seller? Nope. 150. So this is 225 minus 150. It says they resold 105. So what part did they not resell? 225 minus 105. And then the percent of ownership? 25%. you do the math there, you should get $10,000. You'll notice, as always, the book just gives you what they need to give you to get to the number. And I always give you the same protocol for every problem, right? I'm sorry. If you can do it their way, it's faster. What they did was 120,000, which is the ending inventory, times 33 1/3%, that's the gross profit percentage, okay, times the ownership. So if you can do that, that's fine, $10,000. And then the journal entry, debit to investment income, which they call equity income from shilling in this problem. It could be called equity investee income or investee income, but income is critical. Income, it's a revenue account. Debit or reduce the income account, and credit or reduce the asset investment in shilling. There. You got it? It would go here and here. So your debit is the revenue, credit is the asset. Questions? Good? Okay. So I said we would do 26. It's a little bit more comprehensive, and it's a good problem. On page 33, on January 1st, 2014, Allen acquires 15% of Bellevue for $62,000, and they classify the investment as an available for sale. So which method are we using? Fair value method. Records any unrealized holding gains or losses directly in the owner's equity. On January 1st, they buy another 10%, and that provides the ability to exercise significant influence. Because now we have 25%, it's between the 20 and the 50, and we do have that ability, and therefore we're switching, okay? Which means we have to do a retrospective adjustment, right? For at the 15%, right? So what we would have recorded, is there a different, yeah, I need to leave that up there too. What we did record when we bought it, it says we bought it for $62,000. In the first year, the dividends were $30,000. So the journal entry would be, well, debit to AFS security credit cash 62. And then when we got the dividends, debit cash credit dividends for $30,000 times our 15%, 4.5, right? And we would have done that appropriately. But then at the beginning of 2015, we actually buy another 10% for 43.8. So you'll notice they did well. Actually, they don't. Let me see. Any excess. See under that little chart. In each purchase, Allen attributes any excess of cost over book value to a franchise. Remaining life of 10 years. Okay, so they did 2 DDESs. One for the 15%, the $62,000 is the purchase price. Okay. See it over here? The net book value at the time, it said, and how did I know that? That I had to go backwards. The fair value of the common stock, 438. Did they tell you 280,000 somewhere? Yes. Okay. Book value of 280,000 on that day. That's in the book, right before the little A. So our purchase price, we've got $62,280 times 15%, and we attribute all of that to the franchise, divided by 10, out to the side, $2,000. So far, so good. But we didn't do that because we were using this method. But what we would have done, had we been using this method, is we would have done we would have done 62,000. Our share of net income, 80,000 times 15%, 12,000. Amortization, 2,000, and dividends, 4.5, right? What we would have done, and over here it would have been 12,000 and 2,000. Dividends aren't in there. So we would have recorded 10,000 of net income, but what we did record was 4,500 of net income. And so the journal entry to get that back to we start with the 62. We're going to make a journal entry of 12 minus 2 minus 4,500. In other words, we want to remove the 4,500, record the 12,000, and record the negative 2,000. So our adjusting journal entry, or our retrospective entry, 12 minus 2 minus 4.5. We did put 4,500 into retained earnings. But now we want to get that out of there. We did not put the 12,000 or the 2,000 in. So it's the 10,000 minus the 6,500. 12,000 minus 4,500, right? Those three things, the combination. Removing this, putting these two in. Okay? And so that's what they did here, 62,000 plus 12 minus 2 minus 4,500. So the equity method adjustment, 5,500 would be debit to investment, 67.5, credit to AFS, 62,000, and credit retained earnings, 5,500. Okay? Investment in the company, 67.5, credit AFS securities, and credit retained earnings for the retrospective adjustment. Okay. Then we can keep going. Then it says we bought another chunk, and so they did another DDES. And that year, in 2015, we paid $43,800. Here's $43,800. The book value has changed for the company. It's gone up for net income and down for dividends. The company's no longer $280. That was a year ago. A year later, they've added income, subtracted dividends, so their new book value is $330. And we bought 10% of that, is $33,000. So we had an excess of $10,800. Remembering that this was 10 years for that franchise in 2014, well, 1 year's gone by, so this is now 9 years, 9 remaining years, or $1,200 amortization each year. Right? So we're ready to put our numbers in. We have 67.5 as our beginning balance here. We added 43.8 as the new purchase price. We have two amortizations, a 2,000 and a 1,200. Amortization number 1, amortization number 2. We have 25% of net income, 15 plus 10. I don't know. net income for that year is 100, so this would be 25,000. 25% of the dividends, 40,000 dividends, be 10,000 for dividends, right? And then in this year, it says we also I guess there is no gain. There's no intercompany. When I saw that thing, I was thinking that it was that we had an intercompany inventory, but we don't. So this would be our investment balance, whatever that comes up to. And then, let's see. And then this would have been, for that year, would be net income would be 25. We'd have 2 and 1.2. And that would be, there's no deferred gain, there's no last year's deferred gain. So we have whatever that is. That's 3.2, 22.8 or whatever, 21.8. This is a very comprehensive one, except that it doesn't have the deferred gain. 27 has all the above. So they just get harder, right? So I suggest you just spend some time with your book. Make sure you can walk through each one of those problems. Okay. But again, remembering the 6 pieces of that puzzle and the 4 pieces of this puzzle. Questions so far?
10,000. I was lost, but just like where you got that, I was just lost.
They gave us dividends for
They do the same.
40,000,
Okay.
and we own now 25% of 40, it's 10. It's always our share,
Okay.
but it's 25% because we own the 15 plus the 10 now. Thank you. So just memorizing the 6 pieces, plugging them in. Okay. So, would you please stop the